Good morning, folks. Markets are up again today, and once again, we have a member of the Federal Reserve to thank for that. Also, MicroStrategy and Michael Saylor might be in even more trouble than I initially thought, but we're going to get into more of that in just a moment because Bitcoin is currently trading at a price of $88,481. That means from the lows we put in on last Friday, to current pricing, we're up nearly 10%. And we topped out today at about $89,252, which would have put us up over 10% from those lows that we put in last Friday. We are still down something like 30% from the all-time highs. Let's get a measurement on that. That puts us at just about bang on 30% down from those all-time highs. But obviously, we're making moves to recover some of that. Now, unfortunately, of course, because this is crypto, a lot of people saw those green candles and started stacking into long positions, meaning that we do have elevated long side liquidation risk in the market, currently up at about $755 million. That is nearly $1 billion worth of long liquidation risk, but it is sitting cumulatively down at a price of $79,765. Now that means that if prices were to teleport down to those levels right now, that would represent a $755 million liquidation risk in theory. Okay, in practice we wouldn't come down that quickly, hopefully not usually anyway, and some of those positions would unwind before they were actually liquidated. But why is this a risk? Because when positions are liquidated, when long positions are liquidated, the exchange forces selling of those positions onto the market, dumping supply onto the market, and that sudden supply shock brings prices down very rapidly. We do, however, over the 30-day time horizon, this is speaking more generally, have more shorts in the market versus longs. Although this is cooling off, the trend for this has been down over the last couple of weeks. Currently about $2.62 billion worth of short side liquidation risk to the upside. Basically, this points to a lot less leverage in the market than we have been used to. We know that that big sell-off towards the beginning of October was triggered by a $19 billion liquidation event. But it's looking like liquidation risk caused by leverage in the markets is cooling off somewhat. Now, if we look at the market as a whole, right, first of all, we were just assessing Binance there, but we're looking at just under $8 billion worth of short side liquidation risk on the 30-day time horizon in the market as a whole. Again, it's cooling off somewhat, but there is still a risk of a short squeeze type situation because, of course, when short positions become liquidated, the exchange goes out and buys Bitcoin on the market, causing a sudden demand shock and the opposite of the effect that I just described. But what is happening right now, because we do have an even more elevated chance of another 25 basis point rate cut at the December FOMC meeting, and this is all thanks to the Fed's Mary Daly. So Mary Daly has also come out and said that she supports a December rate cut, once again citing the job market, similar to our old friend President Williams, New York Fed President Williams, who also cited the labor market weakness as posing a bigger threat than higher inflation. So just to give you the blow by blow on this, San Francisco Federal Reserve President Mary Daly said in an interview with the Wall Street Journal that she supports a December interest rate cut, citing labor market weakness. Daly's comments follow remarks from Fed Governor Christopher Waller, a voting member at the central bank, about backing a cut in December. So there we go. Chances of a rate cut elevated massively. This is totally flipped from just a few days ago. The Fed is stepping in to save us, to save the stock market. And I think a lot of people are saying that they really have to do that because of the risks that we have with the US stock market right now and the situation that the economy is in as a whole. It would be a very bad thing if we saw plummeting valuations. And the stock market like that a lot. Okay, so the S&P is up about 3% on the news from those Friday lows again. And from yesterday, we're up something like 1.5%. So for now, it's all plain sailing. I wanted to mention this story as well because it seems like MicroStrategy and Michael Saylor might be in even deeper trouble than I suggested they were in yesterday's video. And there's two pieces of news here that I want to cover. The first is JP Morgan basically fudding MicroStrategy. Now I've seen this article. I've seen articles from or releases from JP Morgan relating to this popping up all over the place. But the headline is JP Morgan warns of MicroStrategy delisting risk from major equity indices. Now we mentioned this in yesterday's video about the MSCI threatening to potentially start removing some of these companies holding Bitcoin on the balance sheets from the MSCI indices, and why that was potentially a bad thing for institutional interest in crypto. But we've got JP Morgan parroting the same thing, and I've actually heard a rumor that JP Morgan might in fact be shorting MicroStrategy themselves, hence they're flooding the markets to try and bring prices down and cash in on that trade. I haven't seen any evidence as to whether or not that is substantiated, but it's certainly an interesting theory. MicroStrategy, now Strategy, the world's largest corporate holder of Bitcoin, is facing its most consequential structural risk since Michael Saylor began transforming the software firm into a leveraged Bitcoin vehicle 5 years ago. And this is exactly what MSCI is saying, right? They're saying that these companies holding Bitcoin on the balance sheet, holding Bitcoin in their treasury, are behaving more like funds than they are behaving like regular companies. Therefore, they shouldn't be eligible to be part of those indices anymore. The warning comes from a new JP Morgan note that says the company may be removed from major equity indices, including the MSCI USA index. The MSCI USA index is a major stock market benchmark created by MSCI. It tracks the performance of large cap and mid cap US companies, representing about 85% of the US stock market. And at the same time as this, we've got Tom Lee talking about how MicroStrategy stock has become a key risk management tool for institutions, for investors that want to hedge against Bitcoin going down, because it's much easier for them to short MicroStrategy, right? I just mentioned the rumor that JP Morgan might in fact be shorting MicroStrategy. Again, I don't have any evidence for that. I haven't seen any evidence for that just yet, but they do seem particularly bearish. But we know, according to Tom Lee, who's talking about this, that institutional investors are using MicroStrategy stock or using shorts on MicroStrategy stock. They could be using the futures market, they could be using the options market, but either way, they are betting on MicroStrategy going down as a way to hedge their long exposure to Bitcoin, right? Their investments in Bitcoin. Because MicroStrategy holds so much Bitcoin, its movements essentially track with a buffer what Bitcoin price is doing. According to PA News, BitMine chairman and CEO Tom Lee highlighted in an interview with CBDC that due to limited on-chain options, right, that would be shorting Bitcoin itself through the futures market or something like that, Strategy, MSTR stock, has emerged as a preferred tool for cryptocurrency investors to manage risk. Institutional crypto investors are using MSTR, that's MicroStrategy stock, to hedge losses, resulting in a 43% decline in its value. Tom Lee explained that Strategy holds a substantial amount of Bitcoin. Thank you, Tom Lee, for explaining that to us, totaling 650,000 coins, and its liquidity surpasses that of BTC and ETH derivatives. Consequently, when crypto liquidity dries up and market makers are impacted, institutions find it challenging to hedge effectively on-chain and resort to shorting MSTR to offset losses in Bitcoin and Ethereum. So there we go. Things not looking great for MicroStrategy, things not looking great for Michael Saylor if this general sell-off that we're in continues. But at least in the short term, it is looking like the Fed's playing ball. It's looking like they're playing into the hands of the stock market, which means they're playing into the hands of risk assets in general, and that is good for crypto, at least for the time being. But as always, just my opinion, just what I'm looking at, purely for entertainment purposes, not financial advice. Thank you so much for watching. Plenty more to come.